Hey everyone, welcome back to Corporate Decoder. Today, iDirect Private Markets Fund filed its latest form N-2, and I am seeing some interesting trends in its expenses and share structure that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This fund is all about private markets, and their latest filing shows how they are handling investor money and the costs involved. So, let's dive into what this filing is all about. iDirect Private Markets Fund is essentially a way for investors to get into private equity. Think investments in companies that aren't publicly traded on the stock market. They have two main types of shares, Class A and Class I. Class A shares come with a sales load, which is like a commission paid when you buy them. In this filing, they're saying you could pay up to 3.50% of what you invest as this sales load. The fund's distributor or a selling agent can choose to waive some or all of this fee, which is good to know. Now, when it comes to selling your shares back to the fund, there is an early repurchase fee. If you sell your shares within a year of buying them, you'll pay a 2% fee. This fee goes back to the fund to benefit the other investors. They can waive this fee if they think it is in the best interest of the fund. This next part is really important because it talks about the money that goes towards managing the investments themselves. The fund invests in other investment interests, and these underlying investments have their own fees. The filing mentions that these private equity investments generally charge annual management fees between 1.50% and 2.00%, plus something called carried interest. Carried interest is a share of the profits that goes to the investment manager, and it can be quite high from 20 to 30% of the net profits. The filing shows an acquired fund fees and expenses of 0.63%, which represents the management fees and operating costs of these underlying investments. It is crucial to understand that this doesn't even include the carried interest, which can be a significant additional cost that is paid out only when profits are realized. They also mention interest payments on borrowed money. The fund might borrow money through a credit facility, and these are the costs associated with that. In the prior fiscal year, these costs were 0.09% of their assets. Then there are other expenses. For the current year, these are estimated at 0.26%. A good chunk of this 0.03% comes from income taxes for a subsidiary called IDPE Subsidiary LLC. Without those taxes, the other expenses would be lower. These tax expenses can really change from year to year, making them unpredictable. Let's look at the financial highlights, which give us a snapshot of the fund's performance over time. For Class A shares, the net asset value per S-share at the beginning of the year ended the 31st of March 2026 was $17.62. By the end of that year, the net asset value had grown to $18.62. This looks like a positive move for Class A shareholders. The total return for Class A shares during that year was 7.25%, which is pretty solid. Now, for Class I shares, which don't have that sales load we talked about earlier, the net asset value at the beginning of the year ended the 31st of March 2026 was $38.71. By the end of that same year, the net asset value had risen to $41.15. This is a significant increase compared to Class A. The total return for Class I shares during this period was 7.89%. Even though Class I has a lower expense ratio, its total return is slightly higher in this period. It is interesting to see how those fees can impact overall returns. Looking at expenses for Class A shares, the ratio of gross expenses to average net assets was 1.85%. For Class I shares, it was 1.25%. That difference of about 0.60% per year is pretty significant when you are talking about investment returns over the long term. It shows that even though Class A shares have a sales load, their ongoing expenses are higher too. The fund's main goal is long-term capital appreciation, meaning they want the value of your investment to grow over time. They aim to do this by investing at least 80% of their assets in private equity. A big part of their strategy is to focus on investments managed by big names in private equity like Kohlberg, Krabus, Roberts, KKR, Vista Equity Partners, and Warburg Pincus. They are trying to transition the fund so that about a third of the money goes to each of these managers. The fact that they are heavily relying on these specific managers, the core managers, is a key part of their strategy. They believe these managers have strong track records and expertise. The fund plans to invest about 5 to 15% of its assets in more liquid securities to help manage cash. Now, they are very upfront about the risks involved. Investing in shares of this fund is considered highly risky. Private equity itself is a high-risk investment, and this fund is no different. They emphasize that you could lose your entire investment. One of the biggest risks they highlight is the lack of liquidity. Unlike stocks you can easily buy and sell on an exchange, these shares are not publicly traded. There is no guarantee you'll be able to sell them when you want to. The fund may offer to repurchase shares, but it is not a daily thing like with mutual funds. They can limit how much they repurchase, and it can take a long time. This means you should only invest money you don't need for a long time. They also point out that investors will bear substantial indirect fees and expenses. This means you are paying fees for the fund itself, and then you are also indirectly paying the fees of the underlying investments that the fund owns. These combined fees can eat into your returns. Leverage or borrowed money might be used to fund investments. While this can potentially boost returns if investments do well, it also increases the risk. If investments don't perform as expected, leverage can magnify losses. The fund can borrow up to a certain regulatory limit. Valuing these private investments is also tricky. The fund relies on valuations provided by the investment managers, often on a quarterly basis, but the fund calculates its own net asset value monthly. This difference in timing can lead to inaccuracies. And there is a risk that the valuations provided might not be perfectly accurate. They mention that they can't independently confirm the accuracy of these valuations, and errors could go unnoticed for a long time. The fund's investment advisor is iCapital Registered Fund Advisor LLC, which is part of iCapital, a financial technology company. They manage the fund's investments and aim to provide access to private markets that are usually hard for individual investors to get into. The fund pays its advisor a management fee. This fee is 0.90% annually, calculated on the fund's net asset value. This fee is paid out of the fund's assets. Importantly, this fee is separate from the fees charged by the underlying private equity managers. When you look at the total annual expenses for Class A shares, it is 2.37% of the fund's net assets. For Class I shares, it is 1.77%. This difference is largely due to the distribution and servicing fees that Class A shares have. Over time, these ongoing expenses can have a significant impact on your investment growth. Looking back at the Class I shares financial highlights, the net asset value at the beginning of the year, ended the 31st of March 2026, was $38.71. And by the end of that year, it had grown to $41.15. This is a gain of about 2.44 per S-share. The total return for Class I shares, excluding sales charges, was 7.89% for that year. That sounds pretty good on the surface, but remember, this doesn't include the sales load for Class A shares. The fund's net assets grew from $635 million to $830 million by the 31st of March 2026. That is a pretty substantial increase, showing that more money is flowing into the fund. The ratio of gross expenses to average net assets for Class I shares was 1.25%. This means for every $100 invested, about $1.25 go towards covering the fund's operating costs before any reimbursements or waivers. Overall, this fund is targeting long-term growth through private markets. They are relying heavily on a few big managers and are very open about the risks, especially the lack of liquidity and the significant fees involved. The financial numbers for the year ended March 2026 show positive growth in net asset value and total returns, particularly for the Class I shares. The increase in net assets also suggests investor confidence. But the biggest takeaway here is the illiquidity. If you need access to your money quickly, this is not the investment for you. The fund's reliance on these specific managers and the high fees are also crucial points to consider. The difference in expenses between Class A and Class I shares is substantial and directly impacts investor returns over time. That is my take. Stay decoded. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below.